Properly administering a trust is an essential part of a trustee's fiduciary duty. One facet of trust administration that non-corporate individual trustees may not be familiar with is the filing of an annual fiduciary income tax return at both the federal and state level, if applicable. Choosing the correct type of trust under which to file this return requires a careful analysis. The two most common entities are the simple trust and the complex trust. The key factors in whether a trust is simple or complex relate to determining the trust's beneficiaries and what can be distributed from the trust to those beneficiaries. A simple trust does not distribute any amounts from the trust's principal, does not provide for any amounts to be paid, permanently set aside, or used for charitable purposes, and is required to distribute all trust income to the beneficiaries. A complex trust may distribute principal to the beneficiaries, may make distributions to charities, and typically is not required to distribute all trust income to the beneficiaries. Similar to the standard deduction for individual income tax returns, a trust has an exemption that lowers taxable income on a fiduciary income tax return. Simple trusts have a $300 exemption. Complex trusts generally have a $100 exemption. Whether a trust is simple or complex is not necessarily a permanent selection. Entity selection should be evaluated every year a fiduciary income tax return is filed, as the trust may be simple one year and complex the next based on the trust agreement's language. Whether you are interested in creating a trust or need help with an existing trust, a professional's guidance can help design a trust that balances your goals, determine the appropriate trust entity, and make sure your returns are properly filed. Contact us today to learn more.